This video is for educational purposes only and is not investment advice. Please consult a financial advisor before making any decisions.
The US and Israel launched a joint military operation against Iran, and they called it Operation Epic Fury. Now, this wasn't just some small, targeted strike. It was big enough that it resulted in the confirmed death of Iran's supreme leader. Well, as you can imagine, Iran's response was fast and furious. They fired missiles not just at Israel, but at major U.S. allies all over the Gulf. We're talking the UAE, Qatar, and Saudi Arabia. Just like that, in a matter of hours, the entire region was on fire. But here's the thing. The actual fighting is just the spark. The real reason this immediately became a global economic nightmare comes down to one tiny little strip of water. And that would be the Strait of Hormuz. It's just a 21-mile wide channel, but you have to understand this is basically the jugular vein of the world's energy supply. I'm not exaggerating when I say it is the most critical energy choke point on the entire planet. And just look at how much we depend on it. We're not talking about a small percentage here. Almost a third, a full 30% of all oil that's transported by ship has to squeeze through this one single corridor. That's about 13 million barrels of oil every single day. Now, here's the really crucial part. Iran hasn't technically declared a blockade. They don't have to. All they're doing is getting on the radio and broadcasting warnings that no ship is allowed to pass. That threat alone, plus a 50% spike in insurance costs for ships, has caused traffic to just crater by 70%. So for all intents and purposes, the strait is closed. So, this sudden shutdown in the Gulf, what exactly did it do to the financial markets over the weekend? The oil market's reaction was, well, explosive. Brent crude closed Friday at just under $73 a barrel, but during weekend trading, it shot up 10% to around $80. Analysts are now guessing it'll open somewhere in the $85 to $90 range, and if this closure lasts, we're going to see prices blow past $100. And this is key. The market is no longer just pricing in risk, it's pricing in an actual physical shortage of oil. And of course, the stock markets felt that shockwave immediately. On Friday, both India's Nifty 50 and the US Nasdaq closed down more than 1%. But, that was just the appetizer. Now, analysts are predicting a massive gap-down opening when the markets reopen. That means prices are expected to start the day significantly lower than where they ended on Friday. So what does a gap-down even look like on a chart? Well, it's pretty much what it sounds like. It's when a stock opens way lower than where it closed the day before, creating a literal gap in the chart. This big red candle you're seeing, that's the visual of pure panic. It means sellers are flooding the market right from the opening bell, overwhelming buyers before most people have even had their first cup of coffee. But a temporary drop in the market isn't what people are truly afraid of here. The real danger is a much more toxic, much more painful economic situation that this oil shock could unleash. So, what makes this time different? Why is a long-term oil shock so uniquely dangerous for the global economy right now? It's because it creates an economic trap. First, oil prices spike and they stay high. That immediately pushes up inflation on everything else, so central banks like the Fed, which everyone thought would start cutting interest rates, are now stuck. They have to keep rates high to fight this new inflation. But, and here's the trap, at the very same time, those high energy costs act like a giant tax on all of us, on businesses, and that grinds economic growth to a halt. The result? You get the worst of both worlds, stagflation, high inflation, and an economy that's going absolutely nowhere. Okay, so the big picture looks pretty bleak, but in every crisis, there's always a strategic response. So what are the experts saying investors should actually be doing right now? The consensus really starts with a shift in your mindset, and this quote says it perfectly. The whole idea is that these moments of extreme fear, when everybody is panic selling, can create what's known as a V-shaped buying opportunity. A super sharp drop followed by a super sharp recovery. For investors who can keep their cool, this fear can actually be an advantage. So if we look at commodities, the playbook is pretty straightforward. Gold is the king right now. It's the ultimate safe haven, and analysts are calling it a buy and hold. Silver has also jumped, but since it's used in industry, it's a bit more vulnerable if there's a recession. So the strategy there is to take your profits on these spikes. And for crude oil, the message is loud and clear. Do not try to short this market. Hold what you have, or maybe selectively buy producers who are far away from the conflict.
For the Indian market, the strategy needs to be a lot more precise. Since India imports about 85% of its oil, the broader market is super vulnerable. The advice there is basically to wait and watch. But one sector is standing out as a real buying opportunity: Indian defense stocks. They often act as a kind of geopolitical barometer. For the big blue chip stocks like HDFC Bank, the advice is to buy on major dips for the long term. But for a stock like IRFC, it's probably best to avoid it for now because of other pressures.
And flipping over to U.S. tech, their main vulnerability isn't oil directly, but the threat that interest rates are going to stay higher for longer. Still, analysts are looking at this weakness as a golden entry point for the absolute best companies. NVIDIA is being called a premier buying opportunity on this dip. Meta is a buy because it's basically a cash flow machine. Microsoft is at a critical do-or-die support level, which could make it a huge strategic buy. And finally, Netflix is a strong buy, getting a lot of credit for being smart with its cash.
So let's wrap this up with the key takeaways. A new war has shut down the world's most critical oil choke point, and that's creating a real physical shortage. This is threatening to send oil flying past $100 a barrel, which could trigger a global stagflation shock. While India's market is in a tough spot because of its oil imports, analysts are actually framing this whole crisis as a major V-shaped buying opportunity for long-term investors. The main strategies? Buy gold, get very selective with sectors like Indian defense, and pick up high-quality U.S. tech stocks on major dips.